Tuesday, October 31st, 2023, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at the pensions time bomb, and actually it has gone off, unfortunately, and a lot of people are going to get hurt, and that's what I'm going to look into today. And it doesn't make me happy to talk about this. But of course, I've been warning for years that interest rates would not stay near zero forever. And that's the main reason why we're having this problem. Before I start, though, just like to say that Oliver Temple from Gold Investments contacted me yesterday. And he's got another special on 1 ounce Krugerrands, 1 ounce gold Krugerrands. Instead of 0.5% off like you usually get for using Monaco 64, you're going to get 1% off. So you need to use the promo code Monaco 64 Krug, Krug. I'm going to put all the details below in the description. He still has the 5% off from various states' sovereigns, and the promo code there is Monaco 64 Sov. And for everything else, and you have to do this separately if you're going to buy something else, it's always Monaco 64, and you always get 0.5% off the price that he's asking. And of course, I've got my affiliates in the United States as well. Check them out. They always have specials, especially Miles Franklin, but also ITM trading. So what about gold and pensions? Well, Oliver Temple at Gold Investments used to SIP gold for pensions. He's right now looking for someone who could do that for him. He lost the deal that he had with a pension provider to basically allow your physical gold to be SIP'd, and Gold Investments would keep it stored at their private vault. So we're trying to find someone who can do that. So right now he can't do it, but I will let you know, especially with what we're going to talk about today, about pensions. First of all, I'm going to give you my take on pensions, because I started out along with my wife, because at the time she was still working in the city. Yes, I met her when I first came to London. She worked for Barings Bank. Yes. And so we set up a private pension back in the mid-90s. And it's what's called a defined contribution. You pay into it. You go through a financial advisor. And that's the other problem. People think that financial advisors and pension fund managers are there to protect the pot that you put in. But it's anything but. A lot of these people don't even have an economic background. They don't have an idea of where interest rates are going to go, of where the economy is. Of course, they are qualified as per the regulator. They have their, they are, they have their licenses to deal in those products that they offer you in your pensions, like different funds, right? Different asset classes. And that's the whole problem, because I could tell that the financial advisor we had, he was a very nice individual, but he didn't know much about economics, the macro picture. But he knew, of course, of all the rules, how much you could put in, how much you could get because of the tax, how much tax you paid. They know all these things. But when it comes to what's been happening in the last few years, and the fact that interest rates have gone up through the roof and no one expected it, none of these people know that. The other thing I would say, and we're going to look into an article about this, is that there are different kinds of fund managers out there. There are fund managers who run equity funds, fund managers who run property funds, fund managers who run bond funds. And that's who they put your money with, be it through a defined contribution, which is you kind of run it, you put how much you want, and at the end of, when you're going to retire, you expect it to have a certain amount, and then you put it into an annuity. There's also a defined benefit, which is usually run with company pensions. So they tell you that at the end of your career, when you're about to retire, you're going to get, let's say, 70% of your final salary. So that's a defined benefit. But anyway, the fund managers, they don't really have an idea of your goals or how much you want to have. All they want to do, let's say, a UK government bond fund manager or a bond fund manager. Let's say 1 year Schroeder's pension fund, government bond pension fund, was up 10%. And then you have another one, let's say the St. James's Place pension fund. They were up like 15%, so they outperformed the other fund. So that's all they care about, outperforming their peers. They don't care. They don't look at what's going on and the fact that we could have a huge bear market in bonds. And the other thing as well, we have to blame the regulators, the FCA, and other people that regulate pensions and investments, because according to them, you need a balanced portfolio, which doesn't seem bad, right? You have some stocks, equity, even property fund or bond fund. And bonds, of course, are supposed to be safe. That's why they have this 60-40 allocation of equities and bonds. But for the last 2 years, they've been anything but safe. Yes, the NASDAQ has recovered this year. But yes, of course, none of these fund managers or financial advisors know anything about gold, especially physical gold. And physical gold in a lot of countries, of course, especially at least here in the UK, is not considered a financial asset. But going back to me, I had no problem with our pension up until the early 2000s. And then we had the dot-com bubble burst. And I realized that these people weren't really doing a proper job of basically protecting your wealth, because it took a big hit, my pension, my wife's pension, and that's why I decided to stop paying into it, and that's why we started buying gold. And of course, no one's going to tell you in the financial industry that gold has gone up about 10% a year since the year 2000. So gold is supposed to be a risky asset, right? That's what they tell you. I've had many people over the years, acquaintances, asking me, well, I have this money saved that I put into a bond. It's going to mature. What should I do with it? I said, well, think about getting some gold. And the majority of people never did it because they think gold is risky because it's a commodity, and they don't realize that gold is money. So let's go and look at this article that came out actually on the 30th of October, yesterday, and it's from thisismoney.co.uk. So, and yes, the pensions time bomb has gone off, in my opinion, and this is proof of it. So here's the story. I'm about to retire. How could my safe pension fund plummet by 30%? David Norton has always been reassured he's on track for a happy retirement. But when this year's statement arrived, David was horrified. More than £75,000 had been wiped off the value of his pot in 1 year. So let's go quickly through this article. I'm going to put a link to it below in the description so you can read it more slowly and look more detailed at it. David Norton has always been reassured he's on track for a happy retirement when he checks his annual pension statement. But when this year's statement arrived in the post from his pension company, Aegon, in February, he was horrified. More than £75,000 had been wiped off the value of his pot in 1 year, sending it plummeting by 30%. 1 year away from retirement, a fall of this scale had put David's well-laid plans in jeopardy. Nervous about his nest egg, the 65-year-old home-fitting sales manager has been checking his pension each month ever since. To his horror, it has fallen further. His pension pot, which sat at £252,000 just 18 months ago, has dropped to £163,000 this month. David, who's married and lives in London, says, I had a stone in my stomach when I first saw the value. I can't understand how it's lost so much. We're going to come to that in a minute. In the past, it has always steadily increased. It would make sense if it was all invested in one stock, but I'm supposed to be in the safest fund possible. That's why I tell people, don't listen to me either. Do your homework. Try to understand what you're putting your money into. This is one of the most important investments of your life. Why leave it to the experts to keep it in a safe place? Look at money. Look at the history of money. Look at investments and try to... it's easy for me to say, of course, because I've been doing this. But I think people need to be more hands-on and not just give their money to the experts, because this is what happens. Because these experts, these pension fund managers, as I said, all they're trying to do is outperform their peers and get their fees. At 64, David's pension pot was automatically transferred by his pension provider, Aegon, into a fund designed to keep his money safe in low-risk investments. So yes, what they do towards when you're approaching retirement, they move it into bonds. The Scottish Equitable Retirement Fund is 75% invested in UK bonds, with the remaining 25% in cash-like assets. But far from protecting his hard-earned savings, the fund has dramatically dropped in value. Over the past 3 years, the fund has lost 40.5% of its value, according to fund scrutineer TrustNet. This means more than 450 million has been wiped off the value of savers' pensions in this fund alone, with 680 million still invested today. Hundreds of thousands of workers have lost an average of 40% over the last 2 years in similar so-called lifestyling bond funds meant to reduce the risk of a stock market shock as workers approach retirement, according to Leif Calif of stockbroker AJ Bell. So the reasoning here was that they moved into bonds in order to protect from the stock market crash. But in the last 2 years, we've had a stock market crash and we've had a bond crash. And the bond crash has actually been worse this year than the stock market. So why is this happening? And I'm going to stop right here. And you can read the rest of it, because there's other pension providers losing a lot for their clients. There's one here called Clerical Medical Retirement Protection Pension. They've lost about 52% of their funds, and they invest almost exclusively in UK government bonds. So why is this happening? Well, we've got the Bank of England. Not a surprise there, right? The Bank of England and the government to blame with their policy of zero rates. And why did they perform this policy of QE, zero rates, money printing, keeping interest rates artificially low? Well, because we had the crisis of '08, where the whole banking system would have collapsed if they hadn't bailed it out. The whole housing bubble would have burst. So what did these geniuses do? Well, and I've been critical of it even back in '08. I thought the bank should have been allowed to fail, just like in Iceland. And yes, house values should have been allowed to collapse. We would be in a much better place today. So what the policy of zero rates and QE, which were devised by originally the Bank of Japan, but Ben Bernanke pushed it a lot as well. And he said there would be no cost, right? We're paying the cost for it now. So what that did, it kept interest rates artificially low, near zero, the short-term rates. And that brought also longer-term rates for bonds lower. A lot lower than they should be. So since 2009 up until recently, as you can see in this chart, this is an aberration. If you look back to like the 70s, rates were a lot higher. And I would say that things would be a lot better off if rates had been between 5 and 10% in the last 20 years or so, or 15 years. But what's happened now is a lot of these regulators, a lot of the people, the economists, the City of London, the pension fund managers, they never thought that this sharp rise in rates that we've seen in the last 18 months would ever happen. And they thought that this zero rate and low rates was something to do with demographics, that it would stay down there forever. And they've been wrong. And I've been warning about this since I started this channel in late 2015. And I've been warning even and telling people to have some gold outside the system since 2002 when I diversified. So some people might say now, well, how come 5% rate is so bad for the system? Historically, if you go back 300 years, the average Bank of England rate is around 5. Well, the problem is that for the last, since '08, '09, rates were very low. And when that happens, bonds are issued at a certain price. They have a very low coupon, so the debtor pays very little interest. But a lot of these bonds now, they're worth a lot less. Their principal, because interest rates have gone up, so their yields have to compete with interest rates, and all those bonds that been invested in since '08, '09, except of course for the very short-term rate bonds, but the long-term government bonds, they're all underwater, and that's why there is a pensions time bomb, and that's why so many people are going to get hurt. And how is that going to affect people? Well, first of all, in the UK, people still get their state pension, which isn't that much, which is like, I think, just under £1,000 a month. It's better than nothing, of course. But a lot of people, like that guy from the article, what was his name? I forgot. David Norton, he was counting on his private pension to help him retire. And they either gonna have to keep working, they're gonna have to downsize, maybe sell their property, maybe. And now with property prices going down, that's gonna be a problem. So it's a mess. And what's the lesson, in my opinion, about this? Well, the lessons. First one is always do your homework. Never give your money to someone just because they're an expert, because they have the licenses, because they're a pension fund manager, because they're a financial advisor, and they're qualified. Number two, do your homework. Yeah, investing, it's like when you buy a house, you go look at the house, you get a surveyor to look at the house. You do all the homework, right? Because you're putting a lot of your savings or your capital into it when you buy anything. So those are the lessons. The third lesson is that nothing lasts forever. And that zero rates have been a total aberration, just the fiat currency system. And I'm not surprised. So as I said earlier in the video, I'm trying to work out with Oliver Temple to be able to SIP again, to put gold into the SIP again through gold investments. But even if you can't SIP gold, I think the other thing that entices people to put their savings into these pensions is that governments give a kicker, right? They say, oh, if you pay 40% tax, you're gonna get like if you put £100, you only need to put like a certain amount, and it will cover the rest. So people get enticed by that. What I have to say about that is, yeah, forget the enticement and go outside the system, and so you don't have to SIP, and just buy your coins of the realm. They're tax-free, of course, and they're also capital gains tax-free, and put some aside. I'm not telling you to put all your savings into gold, but I'm sure David Norton would have been a lot more. He wouldn't be having sleepless nights if he had bought some sovereigns over the last 20 years. So there you go. With that, let's quickly look at where the markets are this morning. It's 8:32 a.m. London time. We've got spot gold at $19.97. It's up about $1. Range has been relatively narrow overnight. The high's been a $19.99.50. So yeah, I still think we're going to go through 2000 decisively in the short term. We did it on Friday, yesterday, and today we're taking a rest. That's how I see it. But that's, of course, short term. Long term, as I said, gold is going to protect you, in my opinion. It holds its purchasing power. So what about silver? Silver did well yesterday while gold got hammered, and today silver is back down. So it's like a like a seesaw, so to speak. But silver is at 23.20. It's down 12. High's been 23.37, low 07. Dow futures is up 50. The Nasdaq is down 40. S&P is down 3 points. The big news in terms of bonds overnight has been that the Bank of Japan is actually, they've given up on their yield curve control targets. A few months ago, they said, oh, we're going to intervene if the 10-year JGB goes to 1%, and we want to keep it between 75 and 1. And now they said that they're going to allow it to go to 1%. So lo and behold, Japanese bonds fell today in price, and they rose in yields. And right now we're trading at 0.94. That's going to put even more pressure on not just U.S. government bonds or treasuries, but also UK gilts. But this morning, though, the 10-year yield is down 4 basis points at 4.84. I think longer term bonds are still a bad place to be. And there's still a lot of people out there who've been wrong about bonds, who are now saying, oh, it's the right time to jump in. Unfortunately, I think bonds are going to be in a bear market for a long time. So you don't buy the dip. You sell the rallies, actually. You sell the rallies, yeah. And that's what you do in the bear market. While the UK bond market, the 30-year is at 504 still. So a lot of these funds are still in trouble. And they're going to continue to be in trouble, in my opinion. And even if they stop losing, the amount that you're going to get, the purchasing power is going to be a lot lower because inflation's a lot higher than the coupons. So to the currencies, the pound is unchanged, 121.66. The euro is up about 0.2, 106.32. Yeah, the dollar has gone up a lot against the yen. It's up almost 1%. It's at 150.40. The dollar yuan is up slightly, about 1/8% at 7.33. Let's check the other currencies. Aussie dollar is down slightly at 63.64. US dollar is unchanged against the Canadian dollar, 138.26. And the Kiwi dollar is unchanged at 58.46. To the commodities, WTI crude is up 0.2% at 82.62. Brent is up 0.5%, 86.90. Platinum is platinum is unchanged, but I've noticed has gone up quite a bit here. We're at 936. So platinum has bounced off nicely off that 900 level. High grade copper is almost back up to 370. It's up 1/3%. I think BlackRock came out yesterday and said that investors are underestimating the need for commodities and the climate change green agenda. What do I think about that? I'm not too sure. I think commodities are still important, but I'm not sure it will be the green agenda that's going to make them go up in value. It's more the fact that paper assets are losing their value so quickly, and people are going to want more real things. As for the ESG green agenda, I'm not too sure that's going to stick. So there you go. With that, I'm going to wish you all a very good day. Take care. Bye.